So I am just going to start us off with a little bit of introductory information before we get into everything. And I promise I will try and go over it somewhat quickly so that we can get into the stuff you came for. So just a quick reminder, on our next slide, we just have another brief reminder of what our conscious capital course really means. And we have tried to create something that will combine really practical personal finance information with your other values and other kinds of capital, like environmental and social, so that you can hopefully walk away from this course empowered to navigate your way towards a deep and shared and sustainable prosperity, both as individuals, but also as a part of a wider society. So, on a couple very quick notes for housekeeping reasons, we do have a body break planned if you are anxious about needing to go make a cup of coffee, although hopefully not, given that it is 6 p.m., but maybe. And a very important one is that we have time at the end for questions. And I really, really encourage you to write down questions that come up for you as we go, and not to think that you might have a question that's not clever enough to ask. Those are always actually, those stupid questions are the ones that are usually the best. And you are welcome to unmute yourself at the end, put up your hand and speak your question and have a discussion. But if you're not comfortable with that, you're more than welcome to pop your questions in text in the chat as well. Also, after the session, we will be sending you an email and it will have the slides included and the link to the recording of this session. And to kindly also remind you to fill in the attendance register Google form that Sandrine has just dropped in the chat. It's really, really important for us in keeping a track of information and who's attended things. So please do fill that out. It should be very, very quick. And again, to talk a little bit about what we are going into over this session, I think that this is a part of, I feel like we've been making reference to the meat and potatoes of conscious capital, and I do think this is where we're starting to get there. So we are, in summary, going to really be talking about how you can build a resilient investment portfolio, and we're going to be talking about a lot of the basics around interest, diversification, and time. So we are going to define a lot of the terms that might make you feel a little bit overwhelmed around investment and finance conversations. But we'll also talk about how your ethics and values factor into your investment decisions, what ethical options are out there for you, and overall sharing education on how you can make your own decisions about investing, like setting up a portfolio and moving your money in ways that actually work, because hopefully you will know more about the system of investing in South Africa and the products available to you. And you can see on the slide an overview of some of the sections, if we can call them that we're going to be going over. So I think this is pretty exciting, and I don't think that there's anywhere else where this information is being shared at the moment, at least not in one place. So please stay until the end, I guess, is what I'm asking nicely. And I know that many of you are probably returning, or perhaps you're watching these recordings in succession, so I won't linger here, but just a reminder for anyone who is new that Fossil Free South Africa, which is us, are a network of South Africans working to secure human rights and prosperity for all South Africans by challenging the financial and social support for the fossil fuel industry, which is responsible for climate change as well as public health crises in South Africa and around the world. And we want to empower people, communities, and institutions to help our country end its dependence on coal, oil, and gas so we can implement a truly just energy transition to renewables for the sake of the prosperity of both the planet and our people. And in regards to our milestones, again, we have already talked about these for those of you who've been in previous sessions, but I will only mention, I suppose, one of the big ones, especially because we think that many of you are probably students, includes in 2022 the end of a 9-year campaign that was actually the genesis of this organization, culminating in UCT's commitment to divest, which is to remove its investments that it has in fossil fuel companies. And outside of universities, for example, also in 2024, our greenwashing complaint against Total Energy's sustainable development claims in an advert was upheld even after they appealed by South Africa's Advertising Regulatory Board. And that was a huge international precedent, actually. But I will leave it there. And Again, very briefly, the team that you're going to be hearing from in this course and that you have been hearing from is our climate leadership team, which consists of myself, a campaigner, Sandrine, our coordinator, Sam, our sustainable investment analyst, and David, our co-founder and director. And also on a legal note, as always, a disclaimer that we are not certified financial advisors or planners, and all information in this course is for educational and illustrative purposes only. So none of the information we share in these sessions constitutes financial, tax, legal, or investment advice. So we encourage you to see yourselves as the stewards of your own finances and to seek input from qualified professionals when making decisions about products and services. And importantly, feel free to double check our facts because we don't claim to know everything. So I'm going to kind of wrap up the introductory session of this by saying that we would like you to think with a metaphor that might act as a scaffold or a framework that I'm hoping will help you make sense of a little bit more of the technical information. And this metaphor is a forest, whether you're really into fairy tales or movies, whatever it is, wherever it was that you first had the idea of a forest, I want you to imagine that filled with all kinds of trees and plants, tall, short, very old, very new. Some are enormous and ancient trees, some are still young, finding their shape. And underneath all of it is this whole ecosystem of roots and fungi and small plants doing all of their quiet work over time. And this is exactly what we want you to see the idea of investing as, because we live in a world where we often hear the opposite story, like social media telling you about how someone turned 5,000 Rand into 50,000 Rand, or crypto, or digital marketing through Canva or something, and affiliate links. And we hear this message that you could get rich and you could get rich quicker if you just knew the right information, if you just had access to the next right move. And this is a really appealing story, especially in South Africa, because most of us are trying to close gaps that weren't even created by our own choices. But the fast money story is unfortunately usually a gambling story, whereas the investing story, even though it might be a little bit boring and undramatic, is almost always more of a forest story. And so the forest is made out of time and diversity. And these two things you do have access to. They're the only ingredients that really build wealth, unless, I guess, you're a statistical anomaly. And you can't control your luck, but you can control a lot about what things you plant in your forest and how you choose to take care of them. And everything we covered today is going to be in service of this idea of time and diversity. And investing can be difficult for many people also psychologically, because you're contributing hard-earned money to something you won't see the benefits from immediately or for a while. And in this economy, especially for those of us strapped for cash, it can feel really tough. But hopefully after this, when you understand how the mechanisms work and you understand some of the math at play, you can keep going, knowing that maybe a flat, boring curve in your growth or the money leaving your bank account every month to investments is not a failure, because hopefully you understand that, for example, the last decade of a 40-year investment window is where a lot of dramatic growth might happen, and it might feel like it suddenly appears. Suddenly people become wealthy, but it's actually something you can thank your past self for, your younger financial steward who was planting a forest very diligently a long time before. So in this session, we hope you're going to leave understanding that investing is not gambling, and it's not a game that's only for the wealthy or for financial experts, although we also ground this in the understanding that the wealthy do have a huge advantage. And nonetheless, it is the stewardship over your own forest that will mature if you do stay consistent. So we're going to talk about some things like how fees can eat at your forest and what to do about it, how to choose your plants or your funds that reflect your values, and some practical stuff about how to plant your forest, aka how to build a portfolio that actually has this resilience over time. And to do that, I'm going to hand over to Sandrine to get us started.
Thanks so much, Steph. As Steph explained, my name is Sandrine. I am a team coordinator here at Fossil Free South Africa. Once again, really happy to be here with you all, and thank you all for taking time out of your schedules to be here with us tonight. Let's talk about compound interest. Compound interest is something that acts as a powerful financial engine by generating interest on interest. It works like a snowball, where returns are reinvested to produce more earnings over time, accelerating wealth creation, especially over long periods of time. But what's the difference between simple and compound interest? The difference is that simple interest is linear, which means that you earn on what you put in, whereas compound interest is exponential. You earn on what you put in plus everything it's already earned. In previous sessions, we've touched on the work of Warren Buffett. His framing of compound interest and investment is incredibly valuable to understand how he's been so successful at investing. Warren Buffett is not the world's greatest investor because he's the smartest. He started investing at 11 years old and he didn't stop. Roughly 97% of his net worth was accumulated after his 65th birthday. The engine wasn't just skill, it was also time. You might remember that last session we touched on intersectionality. So it is important to note that Buffett had certain privileges working in his favor. His class background, the state of the economy of the US at the time, as well as his access to knowledge about the investment landscape. However, there's still so much we can learn from his investment strategy. Let's look on this graph on the slide, and you will have to excuse me, my section has quite a few graphs, but we'll take them one by one. So let's start with this graph. This graph is really interesting because it allows us to fathom the power of the compounding engine. The graph depicts three different scenarios. So let's make a few assumptions before we get into the data. First, let's assume that there are no tax implications on these investments, that you are investing at the beginning of each month, that the rate of return is 7% per annum, that the inflation rate is 3.5% per annum, and that the time horizon is 35 years. If you look at scenario one, which is the light blue line, you invest 1,000 Rand as the principal amount. You then invest 500 Rand a month for 10 years, and then you stop investing and you don't touch the money for 25 years. You can see that the return after 35 years is almost 1,000,000 Rand. In scenario two, which is the deep blue line at the bottom, you invest 1,000 Rand as the principal amount, and then you hold off on investing for 10 years. You then invest 1,000 Rand a month for 20 years, and then you leave the money. After 35 years, you'll see that you have just over 800,000 Rand. Now let's look at scenario three, which is the purple line in the middle. This is where you invest 500 Rand a month for 25 years, and then you end up taking 45,000 Rand in one go at the end of the 25th year. You'll see that after 35 years, you have just over 800,000 Rand. So what are we learning from these three different scenarios? Scenario one shows the importance of starting to invest early and not touching your investment over a long time in order to truly reap the rewards. Scenario two shows what happens when you wait and how long it can take you to catch up. Scenario three shows the power of lost compounding when you take out a significant sum of money in one go. The proverb goes, the best time to plant a tree was 20 years ago. The next best time is now. What can we learn from this? That even a small amount invested early has a longer runway to climb out of that valley. And I'll get into that a bit more in a bit. So one profound illusion of compound interest is that it feels like nothing is happening for most of the journey. As the financial writer Morgan Housel reminds us, the overwhelming majority of the magic, the explosive, life-altering growth occurs in the final 10% of the timeline. This is why Warren Buffett's staggering wealth is less a testament to any single brilliant trade and more a testament to his 60-plus year runway. Now let's look at this graph. So in the early years, you'll find yourself stuck in what Simone, aka Sam Beck-Bessinger, calls the valley of disappointment. So you can see there. This is the first few years or the first time period where your diligent contributions seem to yield barely perceptible returns. This is the phase where patience is the most critical because you are waiting for your money to begin earning interest on its interest. If you persist through those quiet years, you eventually arrive at Bessinger's other phase, the holy snap moment, typically the final 10 years of a long holding period. This is when the exponential curve, as you can see, bends nearly vertical, and the interest earned on previous interest begins to dwarf your original contributions. But reaching that moment requires a specific kind of discipline. You cannot try to time the markets, and I'll explain what that means in a bit. The evidence is relentless that no one predicts short-term swings consistently, and attempting to do so usually means missing the handful of best days on the market that produce the majority of long-term gains. Instead, embrace the mantra that time in the market is better than timing the market. Timing the market is trying to guess the best moment to buy low and sell high, essentially hoping to avoid losses and catch quick gains. In a bit, I'll explain why that is not a reliable investment strategy. It's important to note that finances are not the only thing that compound over time. What is particularly pertinent for us at Fossil Free South Africa is that things like carbon emissions also compound over time, a wholly negative force unlike that of personal investments. What does that mean? That means that if we continue to emit now at this rate, this will compound towards enormous negative climate impact in the future. What that also means is that all the emissions that we can save today will contribute to a better environment for our future. But let's get back to the money for now. You've probably heard the saying, never put all your eggs in one basket. That's because if that basket drops, you lose everything. Instead, you spread your eggs across several baskets, which means that when one basket drops, the others hold steady. Diversification is not about getting rich quickly. It is about staying rich enough to let compound interest work over time. Diversification is a concept that is essential in investing. What this means is that you're spreading your investments across various asset classes, which means that you reduce risk and enhance potential returns. This strategy ensures that not all your financial resources are exposed to market volatility at once. So I'm going to take you through some of the different asset classes you will encounter while investing. Or, as you can see on the visual, the different eggs that you can add to your portfolio. Let's start with equities or shares. This is when you own a tiny slice of a real business and your returns come from that company's growing profits and any dividends it pays out. Bonds are when you lend your money to a government or a company and in return they pay you regular interest. Bonds can be seen as more stable than equities, but arguably they deliver lower returns over time. Then you have cash or the money market, which we've spoken about a little bit in previous sessions. So this is seen as the safest and easiest place to park your money. But remember that inflation acts like an invisible thief, slowly eroding its spending power. So your savings account, for example, is not actually neutral. It quietly loses ground over time. Then you have property. This is when you can earn returns from, for example, rental income, plus any rise in the property's value over time. But remember that it's less liquid than shares or cash and can be very expensive to buy into directly. We then have the idea of offshore exposure. So remember that this is not a separate asset class. It's not like equity or bonds or cash. It simply means putting some of your money into asset classes that are based in another country and priced in that country's currency. So you're not relying solely on your home economy, or in our case, the rand. So an example would be investing in equity, bonds, or even property in another country or that operates under another currency. So if you look at this graph on the slide, I know it's a bit blurry and can be confusing, but essentially what I'm trying to illustrate with this graph is that you can see how different asset classes function over the years, and we'll break them down a bit more in my section. So you can see, for example, that the top line stocks win over 20 years, but look at the ride, it's very volatile. Essentially, a varied blend of asset class, it gets you most of the return with significantly less volatility. And that's diversification doing its job. Similarly to how when one tree falls in a storm, the orchard keeps producing. Diversification does not eliminate risk, but it decreases it. It means that no single failure will wipe you out. In our last two sessions, Sam explained certain aspects of risk and risk management when it comes to investments, if you can recall. So I'm here today to take this a bit further. Understanding risk is essential in investing. What does volatility represent? It represents the ups and downs of asset classes. Different investments carry varying levels of risk, influenced by many factors, including market conditions or your individual goals. So, knowing how these factors interact helps you make informed investment decisions for your future. Let's look at another graph. As you can see in this graph, stocks exhibit the highest volatility. You can see how on the blue and the green lines, there are sharp drop-offs and significant price swings over time. Yet they also offer the strongest long-term growth trajectory, as you can see if you follow the lines. Bonds, on the other hand, so that's the purple line, show moderate volatility with smaller declines than stocks and a steadier recovery path, but they still carry some risk of temporary capital loss. Cash, by contrast, as you can see by the deep pink line, experiences virtually no volatility or drop-offs, providing stable nominal value. But remember that you, as an investor, will be exposed to permanent capital loss in real terms due to inflation and its eroding purchasing power over time. As you can remember from session one, if you were there, we described inflation as a thief. So let's turn to a few more graphs to really bring this concept home and break it down a bit more. So the graph on your screen right now is the Satrix SA Bond Index. And this illustrates the performance of South African government bonds over time. As a fixed income asset class, bonds are generally perceived as lower risk than equities. But as you can see from this chart, they are not without volatility. Yields and prices fluctuate in response to things like interest rate changes, inflation expectations, and even fiscal policy. So let's look at the next graph. This graph is the JSE All Share Index 10-year chart, which tracks South African equities, a different asset class. So this asset class has historically offered longer term returns, but with significantly greater volatility, as you can see. There are distinct cycles of sharp inclines followed by steep drop-offs, reflecting things like market sentiment, commodity price swings, and even domestic economic conditions. I know I've presented a lot of information and a lot of data here for you today, but what is the takeaway here? Let's bring it home. The takeaway here is that no asset class is immune to risk or volatility. There will be drop-offs and there will be inclines. And there will also be systematic risks that affect all asset classes, like how we said earlier with carbon emissions. One of these risks, and carbon emissions fall within this, is the overall climate crisis, which, driven by the fossil fuel industry, can and will trigger economy-wide shocks, such as policy changes, physical disasters, or even shifts in the market sentiment. So these sort of risks, like the climate crisis, affect all asset classes. So they cannot be eliminated through diversification. You can think of them as systematic or systemic risks. And as opposed to asset-specific risks, you cannot diversify your way out of them. So you have to remain aware. There isn't time today to delve into some of the other caveats of compound interest or to really, really get into it. And there are even existing critiques around compound interests that if we had more time, we would share. But one thing I would recommend, and we will attach this video to the further reading in your post-event email, is that you check out the YouTuber Gary's Economics. He has a really interesting video explaining some of the caveats of compound interest. So just keep your eye out for that video in the further reading. Let's wrap up my session. I think despite all of the risk, volatility, and everything you've learned about the different types of interest and the power of compounding, the one thing that's really important, and this is something that Steph mentioned earlier, is staying the course. So that's time. Let's look at the chart here. We have three investors, as you can see. One investor, and they are all at the same starting point, as you can see on the chart. So one of the investors stayed the entire course. One of the investors missed the best 10 days of the market, and the other missed the best 20 days. You may be wondering what missing the best or worst days means. Let me get into that. So in long-term investing, missing the best days means you're not in the market on a few random days when stock prices jump up sharply. Missing the worst days means you're not in the market when prices crash hard. But here's something that's important to note. The best days in the market almost always follow the worst days. The people who panic exit during crashes are also the ones who miss the recovery. Staying invested through the discomfort is the strategy. It's not just a nice to have. To sum up my point and to emphasize Steph's point from earlier, the two ingredients that you need when you're thinking about your long-term investments and how compound interest can apply to them is time. So that means starting now, even starting small and not stopping. I remember I opened my first investment account when I was maybe second year in university, and I think my principal amount was around 300 Rand. So you can start really, really small. The other important thing, which I've explained through diversification, is variety. So that means spreading the risk so no single storm takes you out. Everything else we continue to cover in today's session will speak to those two concepts. And with that being said, I'll hand over to Sam to take us through more of the plumbing. Thank you.
Thanks, Sandrine. Um, you've just showed us how our money can compound upwards for 30 years, but I want to show you all now something that happens when a force like fees compounds against you for that identical period. So apologies for yet another graph, but it's the most effective way to show most of this stuff. Um, but this graph shows three different portfolios available to an investor who has a 10,000 Rand lump sum to invest right now. So let's say this is you. You have 10,000 Rand to invest, and you have three different portfolios as options for you. And we'll make the assumption that for 30 years, every single year, each portfolio will return 10% gross, which means before fees. And the only variable that shifts between the three portfolios is fees. And here we've got time on the x-axis and the investment amount on the y-axis. So if we look at portfolio A, let's assume that that portfolio is a passive index fund, an ETF, which you may have heard of. So that's something like the S&P 500 or the JSE All Share Index or the Top 40. It's basically just a basket of stocks or assets, whether that be stocks or a fixed income asset class. But it's basically just a machine that tracks a given index. There's no particular specialization associated with the fund that you invest in. Everyone buys the same basket. And let's assume that this charges you 0.4% per year. Portfolio B is an actively managed fund. Think something like Allan Gray Equity or 91 Opportunity, which I'll show you a fact sheet for later. They charge you 1% per annum, and they basically aim to pick the stocks within a given index or market that they then buy on your behalf. And the yellow line, the final one, is 2.5%. This is how much they charge you every year. This is a higher fee structure. Think something like a hedge fund or a very expensive, actively managed portfolio that has performance fees, something along those lines. At year 30, at this final year here, we get to a point where portfolio A ends at roughly 180,000 Rand. This is just after the 10,000 Rand in year zero. So now there's no additional investments. It ends at 180,000. Portfolio C, on the other hand, the orange/yellow line, ends at roughly 90,000. So the same investor, but half the money, just comparing the two portfolios with that 2.1% difference in fee per year. The reason that this vast difference feels a little bit counterintuitive is a 2% fee sounds like it takes 2% of your money. So if you had 100,000 Rand at the end, 2,000 of it was paid in fees. But that's actually not quite the case. A fee like that takes 2% of your compounding engine. And when I say that, your active investment every single year. And the money that leaves as fees isn't just gone from your portfolio, it's gone plus everything that it would have grown into over the remaining decades. This is what we call lost compounding, and it was illustrated in one of Sandrine's graphs earlier. Research by National Treasury confirms this too, and this is just a screenshot that I've taken from a white paper that they wrote in 2013. Reducing fees in the South African context by 2% annually can grow a retirement pot 60% larger over a 40-year period. So if you were 20 years old and you retired at 60 now, and you could end up with R1 million or 400,000 Rand, that's the size of the difference. It's ridiculous. And that's not a rounding error. That's the difference between retiring for many with dignity or retiring with anxiety. Now, the industry will tell you that higher fees will buy you skill, a professional driver instead of a bus, for instance. And sometimes that's true. But the question that you need to ask is the driver actually finding a shortcut? We imagine passive investing, which is basically what I was describing as buying an ETF or some type of index fund, as a bus. So it's cheap, reliable, gets everyone to the same destination, but there are no detours, no personalization. But for most of the time, for most people, the bus will win on cost just because of that graph that I showed you just now. Active investing, on the other hand, is your private driver. This is where a fund manager, an investment manager manages money on your behalf in a unit trust, like we discussed in session 1. This is more expensive, but a good private driver or asset manager can do two clear things that the bus can't do. Can steer around trouble, so avoid a company that could collapse. Think Steinhoff in 2017 as an example for a South African asset manager, or avoid an industry in terminal decline and choose not to hold things like fossil fuel companies, even when the index is full of them. And I think we'll see the good asset managers soon, even if they don't have a particular ethical reason, will stop holding fossil fuel companies just because they are good at what they do and realize that the companies will start to fail. The honest truth is that most active managers don't consistently beat their benchmark after fees over long periods. The evidence is robust on this and uncomfortable for those asset managers in particular. So the question for you or for me isn't to go active or to go passive, which is often a debate, but it's what are you paying the private driver if you choose to go for that option for, and are they actually earning it? So I see there being two legitimate reasons to pay more for active management. Number one, you want to avoid something that the index owns. Let's think about the passive JSE Top 40 fund that holds the top 40 equities in South Africa, so the top 40 biggest companies in South Africa. This will hold Sasol and Exxaro just because those are two of the biggest companies in South Africa. Sasol and Exxaro are two of the biggest emitters in South Africa too. If you don't want those in your portfolio, whether for ethical reasons or investment reasons, a passive index fund is not a neutral choice for you to make. It's an active choice to own them. A screened active fund or a good active manager can give you something there that the index structurally can't, because it can't avoid those. The second option is, in less efficient markets, skilled managers can genuinely add value. The case against active management is strongest in the highly researched US market, and there's lots of resource here that I can share afterwards. But it's less clear in South African equity or specialist impact mandates, for example. So I'd recommend, well, maybe not recommend because we're not financial planners, but a blend is probably the way to go, and that's the way I go. The bus, the passive options, is probably best for your core, so the main part of your portfolio, let's say 60% of your equity section of your portfolio, and then add the private driver or the active manager for your conscious layer. So what you're actually trying to avoid or to try and add value on the top. The takeaway from this section for me is to know what you own, know what you're paying, so know your fees, and then make sure that they are worth one another. Now that you understand the cost layer, we can talk a bit more about the values layer, because once you know how to read a fee structure, the next question is, what is this fund actually buying with your money? And this is where David will take us through conscious selection. There is a body break here, so while you listen to David, stand up, stretch, but I don't think we should take 2 minutes away from the actual presentation. So David, go for it.
Thanks very much, Sam. Yeah, good evening, everyone, and thanks for joining us tonight. I'm David LePage. I'm the director and co-founder of Fossil Free South Africa, and we're very excited to be sharing this course and this information with you because it brings together a lot of the things that we've been working on over the years. So I'm going to be talking to you about responsible investment practices and how they apply to investment. Next slide, please. So there are different terms for responsible investment practices, and one of the phrases that is used most often at the moment is ESG. And ESG stands for environmental, social, and governance, which are three classes of factors that can be considered and should be considered when you're making a decision about whether or not to invest in a particular company, or whether when you're considering the different ways in which that company manages its own operations and its own risks. Next slide. So what are some key ESG issues in South Africa? And just to emphasize again, ESG is another term for what in the past has been called responsible investment or socially responsible investment. And at the moment, some of those key risks for us here in South Africa and indeed for the world in many instances are fossil fuels and climate change, inequality and executive remuneration, executive pay, air and water pollution. Gambling is an increasingly big issue in South Africa at the moment. We seem to be dealing with an absolute epidemic of gambling and gambling risk, which is having very negative social consequences. Tobacco, again, is also a huge risk factor. There are 8 million people a year dying around the world every year still from the effects of tobacco. Alcohol is something that many people do not want to be invested in. And then there are many governance issues, which are often seem quite boring, but are super important, as the Steinhoff debacle a few years ago showed. Next slide, please. So there are two broad sets of possible motivations for deciding that you want to invest in a way that is socially responsible or that pays attention to ESG factors. The one is quite simply your ethics and your principles and your personal morality. And that is, I think, a really important reason for deciding how you want to approach your investment goals. But what's also quite interesting is that it's really clear these days that there are very pragmatic reasons for investing in a way that is socially responsible and that pays attention to ESG factors. There's a lot of evidence, and we've detailed it elsewhere, that really shows that ESG investment actually does pay. The opposite to ESG investment is just chasing returns, just chasing profits. But often that is a very short-sighted approach to building value in the long term. Next slide, please. So each of these approaches comes with its own particular challenges. Ethics are founded in personal values and philosophies and culture. And it's quite difficult for people who are financial services providers to come up with a single ethical approach, given the diversity of people's values and personal beliefs about how they want to invest. So the challenge is for them to come up with something that appeals to a lot of people. Obviously, we think that a particular risk factor that is worth paying a lot of attention to at the moment is climate. But then the risks of the pragmatic approach to investment are that it starts to disregard and undermine ethics and morality, which are themselves a sort of vital layer of human social infrastructure. It's really important that in society we do the right thing even when nobody is looking, and maintain our standards and like those ties that keep us together and functioning well. So ethical investment has very deep roots and traditions, often quite religious roots. In Judaism and Islam, there are many Sharia compliant funds in existence in South Africa today. Modern traditions of ethical investment are traced back to the opposition against slavery from the 17th century, when Quakers in the United States started to oppose investments in companies that were trafficking in slaves. Next slide. And there's also very deep connections to the struggle against apartheid, because it was in the 1970s and 1980s when there was deep-rooted opposition to companies doing business in South Africa, particularly from US universities and from institutions in the United Kingdom. There were very powerful campaigns waged against companies like Shell and Barclays Bank, as it was then. And those campaigns in a strong way sort of started to increase the pressure from ordinary people to get their investment managers to deliver responsible investments. Next slide. So one of the risks that comes with trying to invest in a way that is environmentally and socially responsible is that often these imperatives are used by investment managers as a way of marketing their products. And sometimes that is done in a way that is responsible, but sometimes there's also exaggeration or oversimplification, and that can lead to greenwashing. So it's important to look carefully at the claims that are made for socially and ethically and socially and environmentally responsible products. Next slide. So to help you navigate the South African investment market, a couple of years ago, as Fossil Free South Africa, we created something we call the Planet A Investment Guide, which is the beginnings of an effort to do a survey of more socially responsible and more ethical options within the South African market. We're not saying that these are absolutely ethical and absolutely responsible, but we think they're heading in the right direction. And the way to approach using the Planet A Investment Guide is to decide what your own values are, decide what key issues you want to address in your investment approach. Look at what funds are option, what are there out there, and which particular issues they address for you, and look at how those funds are performing and whether they are delivering the value that you need practically as well as ethically. Next slide. So these are some of the examples of funds that are profiled in the guide. One of them, the Select BCI ESG Equity Fund, we had a part in getting set up a few years ago. We don't have a financial interest, but we do have an interest in seeing it do well and demonstrate that socially responsible investment performs well. And indeed, that fund has performed well, which was one of the top 3 equity funds in South Africa last year. And it excludes all thermal coal and Sasol. But of course, past performance is no guarantee of future performance. The Sanlam Living Planet Fund and Old Mutual ESG equity funds are also good options. And at this point, I'm going to hand back to Sam, and he's going to talk about asset allocation.
Thanks, David. So before you pick which fund you want to buy, you need to know one thing, simply one thing. And let's keep with the car bus analogy. How much acceleration you want and how much brake. Equities are like the accelerator in this example. High speed, high return over the long run, as Sandrine showed us, but the road is bumpy. You feel every pothole. Bonds and cash, on the other hand, are the brakes. More stability, more predictability, lower long-run return. You protect what you've already built, but you're not going to overtake anyone on the highway. The key insight here is that the right ratio of assets, as Sandrine showed us, depends entirely on how far from your destination you are. And this is something that I didn't want to go into too much detail. I have got a slide coming up now that I'll take you through, but there's a lot more in the appendix of the slide deck that I put together if anyone was keen to dig into asset allocation a bit more. In terms of 2 quick examples to compare, we've got profile A on the left-hand side and profile B on the right-hand side. Let's say that you're 25 you have 4 decades until you retire at 65 on the left-hand side. A 30% market drop today is not a crisis. It's a buying opportunity. You can afford to floor that accelerator, buy up those equities. Here you can have roughly, according to the pie chart, 65 to 70% in equities, 15% in bonds, for example, 10% in property or some other alternative asset class, and 5% in cash. The key is to stay invested, as Sandrine told us about earlier, and don't watch it daily. This is also the time where you have the most flexibility to tilt towards ESG screened funds, for example, or to implement your values in your investments. You have as much time as you have until your retirement to absorb short-term performance variance. The values alignment in terms of implementing and integrating ESG into your portfolio should compound alongside your financial return, particularly given how the climate crisis is escalating at the moment. At 55 in profile B on the right-hand side, you are 10 years away from your hypothetical exit. A major market crash right before you start drawing income is genuinely damaging to you. Imagine you are a year out from retirement now and you are sitting with 100,000 Rand down because of the Strait of Hormuz nonsense. There's no time, really, to recover from that. You need to start braking in preparation for potential market crashes or market incidents like this. So this is where you downscale to roughly 35 to 40% in equity, almost half what the 25-year-old is owning, 35% in bonds, 10% in property, and 15% in cash. The key here is to have stability to draw from, and this matters more than maximizing growth in the final 10 years before retirement. The principle connecting these two profiles is that your equity weighting, so the amount that you have in stocks or direct company allocations, should decrease as you approach your retirement. Not because equities become bad or worse investments than they were when you were 25, but because you're shifting from building speed and accelerating to protecting what you've already built, hopefully. A rough rule of thumb that a lot of independent financial advisors use, and would definitely recommend that you speak to an independent financial advisor of your own, is to subtract your age from 100. And that's roughly what your equity percentage should be in terms of your whole portfolio of investments. So if you're 25 years old, you can have 75% in equity. If you're 55, you can have up to 45% in equity. This is simplistic, but directionally it should be roughly right for where you want to be. What Sandrine showed us earlier about the different asset classes and their volatility profiles also shows us that asset classes don't move together, and that's the point of diversification. When equities fall, like they might be doing now, bonds often hold steady. When the rand weakens, offshore assets or offshore currency should cushion the blow for you. Combining low correlation assets, so assets that don't have a strong relationship with one another in terms of their returns, will reduce your portfolio's overall volatility without necessarily sacrificing long-run return for your overall investment. This is a free lunch that investing offers, and is the only one that you can actually believe. The one question that we got before we started this course and before session 1 was, can I or can you have a fully green portfolio or a fully values aligned portfolio? The short answer is technically yes, but practically this looks a bit more difficult, especially in the South African context where there aren't as many options as we'd like. It does require a very specific definition of what responsible or values-aligned investing means to you, and disciplined, clear research into what funds actually hold, rather than relying simply on labels. And I'll show you an example of this shortly. A fully values-aligned portfolio is achievable if you're willing to, 1, define your personal exclusion criteria clearly, so what you care about most, whether that be tobacco or social issues or governance or oil or coal or gas. You need to accept that the universe of options for your fund manager or for you to invest in will be smaller, which means that your investment risk will be elevated due to concentration risk, which we will have explained in session 2. And then you also need to do the work of verifying fund holdings rather than just trusting the name on the label, as I will show you how to do shortly. The more honest answer, and I alluded to this earlier, for most people is a partially conscious portfolio is realistic, where your core investment is in low-cost diversified funds, like those passive index funds that we spoke about earlier, and your kind of values-aligned layer is in carefully selected, actively managed funds by managers that you trust, or in screened funds that we'll talk about shortly. This is both a more practical and robust solution for South African retail investors like yourselves. It's not very easy here to just pick 1 or 2 green funds and call it done. That's concentration, not a portfolio, and the discipline of asset allocation that we spoke about now, so holding different types of asset classes in a mix together, still very much applies within a conscious framework. So, how to choose a unit trust. Hopefully this is the most practical part of the whole course, so hopefully it's useful. So think of a fund fact sheet. So this is just a short list of what a particular unit trust fund holds, like a nutrition label on the back of a tomato sauce bottle. Before you eat it, you should check a few things. How much does it cost? What's actually in it? And does it do what it claims to do? And the same logic applies here. Somewhat of a crude analogy, but anyway. You need to ask yourself, what is the asset class or strategy that the fund manager is aiming to achieve? What do you actually want this money doing for you? Is it supposed to be high growth, so mostly equity? Is it stable income? Are you closer to retirement and want something more stable? Or is it balanced, a mix of multiple different asset classes that changes over time depending on opportunities that the manager sees fit? It's important to mix and match the fund's strategy that you end up buying to the layer of the hierarchy that you're filling. So when I speak about the hierarchy, this is a bit of a throwback to session 1 when Steph spoke about our shield and our bridge and our seeds. Go back to that session if you don't know what I'm talking about. Fees, what is the total expense ratio? What is the total investment charge? Those are just the percentages that I had listed earlier, and I'll dive into a little bit more about what they are in a moment. Performance of the fund. Has it beaten its benchmark after fees consistently over multiple long periods? One good year doesn't mean much for an asset manager. 5 consistent years, or 10 or 20, does mean something though. And this goes back to what we were saying earlier about, can you assess skill on the part of an asset manager? And then finally, what does it actually own? What are its holdings and how do those align with your values? Do they sit right with who you are as a person? So the 91 Opportunity Fund, I've just picked a fund that is an interesting one because it's the largest multi-asset fund in this, one of the largest multi-asset funds in the South African market, meaning they buy a range of different asset classes. And it has a really long track record. So it's got 30 years. And also, I quite like the example because 91, as you can see here on the right-hand side, classify their funds according to ESG. So here they say that it's ESG integrated. That does sound quite reassuring for those who want to integrate their values or morals into their investments, but just hold that thought. If we look at performance, this is where I want to hopefully get practical and show you how to interpret a fund fact sheet. So this fund has done, you can see here, 12.8% since inception. So since it began as a fund. And you can see this also with the green line here. You can see that it's above both CPI, which is inflation, which is the orange line, and its sector, which is what it's using as its benchmark in gray over here. So you can see that annualized, it's 12.8% versus 11.4%, its benchmark. It has done quite poorly on a 1, 3, and 5 year basis. As you can see, it's underperformed its benchmark in these periods. but this is partly a result of perhaps volatility, or the asset manager hasn't done so well in the last few years. Active management definitely has short-term variability, and it's good to look at both the short-run numbers, 1, 3, 5 years, and the longer-run numbers, 20 years and beyond. Now, if we look at the holdings, these are our ingredients that I was speaking about earlier. These are the equity holdings that it has. These are the companies that it holds, and the percentages on the right-hand side of the fund that it holds. So total in this fund is 28.6% in equity, and these are the individual percentages in each company. So I want to highlight a couple of companies. One is British American Tobacco, which is 3.5% of the fund, and the other one is BHP Group, 3.7%. These are 2 and 3 of the top 3 in the fund, equity-wise. BHP is one of the world's largest mining companies with significant fossil fuel exposure, and British American Tobacco is the 3rd biggest producer of tobacco in the world. This is a well-run fund, as we can see from the performance chart that I just showed you, with a strong track record. That's not in question. But ESG integration that they spoke about in their description doesn't necessarily mean ESG exclusion as everyone defines it. I personally don't want British American Tobacco in any fund that I hold, because I feel that tobacco is a particularly enormous and complicated social problem that affects many people. Same goes for fossil fuels, so BHP. So I probably wouldn't hold this fund based on my personal values, but that doesn't mean that it's not a good fund for you to hold. Moving on to the fund that David mentioned earlier, this is the Select BCI ESG Equity Fund. It's a more recently incepted fund. It was launched in 2021, and it's a lot smaller. So it's got 250 million rand. That, I promise, that's small in the context of asset manager funds. This explicitly tracks the S&P's ESG index of South African companies, excluding Sasol, as David mentioned, and companies with concerns around an E, environmental, S, social, or G factor governance. Full disclosure, as David mentioned, Fossil Free South Africa were consulted on the setting up of this fund and assisted in determining the exclusionary policy. We pushed very hard for Sasol to be excluded, but we have no financial interest in the performance of the fund. We were not paid for that consultation. Looking at performance, with a passive fund like this, you expect it to track its benchmark very closely. You can't even see the benchmark here because of how closely it tracks it. This means that it's a good index fund. Since inception, this has done just over 21% annualized, which is very strong performance. As we saw earlier, South African equities have done very well since 2024. 5-year cumulative, it's done 165% versus the category average. So all of the funds that are managed in South African equities across all different fund managers, which is 105% roughly since inception. So you can see that it's done substantially better than the average fund in South Africa over this time. This is the data point that I want to highlight because it addresses the most common objection that we face head on, that ethical investing costs you returns. A fossil fuel screened South African equity fund like this, granted the length of time that they've been investing in this way hasn't been as long as the 91 Opportunity Fund, for example, but it's clearly outperformed the South African equity fund average over its full track record. If we get into more specifics, it's got the ingredients of Gold Fields, First Rand, Valterra Platinum, Naspers, Standard Bank, Anglo Gold Ashanti, Impala Platinum, Sibanye-Stillwater, Absa, and Prosus. These are many of the biggest companies in South Africa, unsurprising for an index fund. But they have no Sasol and no Exxaro, no coal-linked miners. I do want to highlight here that you do have gold and platinum miners, and there's an honest conversation worth having and something that you should think about too. That's showing here that ESG screening is not a purity exercise. It's a specific exclusion policy that's applied with discipline. Sasol is out, and that was part of the mandate, but whether platinum miners meets your personal threshold, given the ethical concerns around diversified miners in South Africa, that's a question for you specifically to ask of yourself. If we're comparing fees here, I just want to briefly explain what the total expense ratio and the total investment charge are. So the TER, total expense ratio here, 2.25% of the opportunity fund on the left-hand side, is basically the amount that the fund manager charges you to run the fund. So to manage your money, they charge you 2.25% of the money that you invest at every given point in time, over every year, rather. And the total investment charge includes the transaction costs that come after they have bought and sold everything. So a fund that does more regular transactions will charge more in that TC transaction cost and therefore in their TIC. So this is the number to focus on. Basically 2.27%, which is a lot of money, of your investment gets taken away every year by the asset manager. And this is before you factor in other costs associated with investing. It's an actively managed fund. They've got a large team at 91. It's the biggest asset manager in South Africa. They've got a long track record of 30 plus years, as I mentioned, and they say that they have asset allocation skills, so the ability to choose when to invest in bonds and when to invest in equities, for example. But as Sandrine mentioned, it's usually better not to try to time the market, but spend more time in the market. The BCI fund, on the other hand, is much cheaper. It's an equity fund, it's a passive fund, and it's just over 1% TIC as at December 2025. And the gap between these two funds will compound significantly, as we showed in that graph example earlier. The question here that I want to come back to before I hand over to Steph is, if you own either of these funds, you are a part owner of the companies that I mentioned here. You're a part owner of these companies. Does that truly align with who you are? We're not telling you that the BCI Select ESG Equity Fund is the best fund for you, or the 91 Opportunity Fund is, or any fund that is right. That depends on many things: your time horizon, your risk tolerance, your cost tolerance, how much you're willing to pay in fees, and your personal values and ethics. But hopefully you have some of the tools now to ask and answer those questions yourself, and interpret fund fact sheets and how to build out correctly allocated portfolios yourself. And as always, consult the appendix and email us if you have any questions. Steph, to conclude.
Thanks, Sam. Yeah, I just have a couple admin points to go over. I see someone has thanked us and said they need to leave, so I promise this is just going to be mostly administrative stuff. And then you can ask some questions for those of you who want to stay to do that. So the first thing I quickly wanted to mention is the homework that we think would be really productive for you to do. So on the next slide, we have 3 very optional steps that you can take. In the green, we've highlighted sort of who can do this. The reason for that is basically because of step 2. But step 1, we really suggest, because all of you listening can do this, is go to your bank's website and find out what they actually fund. So all banks publish things like sustainability or climate reports. It should be fairly easy for you to find out what they're actually funding through these publicly available PDFs on their website. They do make it quite accessible. Spend 5 minutes finding one thing that your bank finances that you either feel good about or that you don't feel good about. And you're a customer of this bank, so this relationship is already a financial choice. So that's a great place to start thinking about this. And step 2, this is for anybody who has an existing investment, including things like maybe an RA, a pension, other similar products. We suggest you take a few minutes to find the name of the specific fund and Google it with the fact sheet. So you want to find the fact sheet for that fund through Google. Again, it should be quite easy to find. And then to go in there and look at the top 10 holdings and write down one company that surprised you, where it's a positive or a negative surprise. And the last one that we think is a great reflective thing for everyone to do is write down 2 things that you think your money should never fund, and one thing that you actively want your money to support. And there's not a correct answer, but I think it's a great place to start integrating your own ethical framework into what you're doing with your money is to think about that. So just to kind of give you a brief recap, because I know that it can be a little bit overwhelming and maybe a question will pop up in your mind that you thought of that got away from you. We talked about compound interest and diversification as the engine that drives building wealth. We've talked about fees. We've talked about active versus passive funds. We've talked about a history of kind of ethical and socially responsible investment and what that looks like. We've talked about ESG involved in these things and how this affects our investment practices. And we've talked about asset allocation and portfolio construction. I'm not going to read to you off this slide, but I'm hoping you've looked at it if you needed the refresher. And so the last couple things from my side at the moment is that I wanted to say again, please keep an eye out for the email we're going to send you that's going to have the slides and this recording and also information about the next session, because I also think it will be very helpful for you when you have these slides to look. We're not going to show you now because we'd have to skim ahead and it would be a whole thing, but there's a very long glossary at the end of all our slide packs. So every single word that we've defined is a definition, and Sam's put together a really cool appendix that has a lot of other resources in there. And make sure our emails aren't going to junk or spam. And then the other very, very quick thing, I promise, is I would really like to ask, if you haven't already filled out the attendance register in the chat, to do that, but to also just scan this QR code and take, I think, really maybe 10 seconds probably to tick yes or no on this multiple choice question in the Google form. And if you want to, let us know if there are other questions that you still have around anything to do with personal finance and saving consciously. We really appreciate you taking the time to fill out this form, because it helps us construct this course and the content better to what people actually are hoping to hear from us on. And the slide we're going to sit on while we do the Q&A is this one. And I think the only one I'll kind of mention out loud is the Future We Want petition. All of these will take you to the website where you can read more about it. But the Future We Want petition is where we ask investors, well, we ask asset managers on behalf of retail investors, so if you're an investor in anything, to create fossil fuel-free funds, or options that are free from fossil fuels. So I think I'm going to leave it there and ask that if you have a question, to put up your hand or to pop your question in the chat. Can you put up your hand in Zoom, Sarah? I'm pretty sure that's a thing. Or am I just not allowed to, because you can raise your hand?
You can. It's under the react button.
See, there's no such thing as a stupid question.
So if you want to raise your hand, you can hit the react button and do so. And maybe in the meantime, Sam, would you like to address Peter's question about the returns on bonds?
Sure, David. So I'm just finding the question. It says, do government bonds pay interest regularly or at the end of the term? The answer is both. So interest are primarily paid by government in terms of government bonds as coupons regularly, usually 6 monthly. And at the end of the term, they will pay back the full amount to maturity. So basically, anything left at the end. It's the same as if you take out a bond to buy a house. It's basically just the government are borrowing money from the investors. So if they put out a 2035 bond, that'll be a 9-year, or 2036, for example, is the 10-year bond, which is often used as a measure of South Africa's economy. Then they will pay the investor every 6 months usually, and then the entirety of the bond will be paid out to maturity at the end of 2036. I hope that makes sense.
Thanks, Sam. Peter, I hope that answered your question. And if there are other questions, guys, please do raise them. one of the things that came up for me, which was interesting while we were developing this particular issue of the course, was that we have this ongoing court case at the moment against Tungela. It's a court case together with Just Share and Eon Asset Management. And the basis of the case is that Tungela, which is a coal company that was spun off from Anglo a few years ago, has not been tabling at its AGM's resolutions that we, as the three parties involved, have been trying to get them to table climate change resolutions. And so since they've done that fairly regularly, we're now challenging them. And while I was researching some of the issues involved for a journalist, I started to think more about the issue of climate damage and how climate damage comes up, and really understood more deeply how climate damage, rather like compound interest, starts to compound in its own way over time, which is kind of a scary phenomenon to contemplate. Apparently, is a novel by Ernest Hemingway called The Sun Always Rises, and in it there's a character who described how he went bankrupt, and the process was gradually and then suddenly. And when you invest and get returns through via compound interest and are fortunate enough to benefit in that way, and as Sandrine mentioned, there are caveats to one's ability to become wealthy by compound interest. But you will experience that phenomenon that was described with Warren Buffett, for example, where for a long time he was just investing and then suddenly he became quite wealthy. The risk that we face as humanity is that we will become very poor very suddenly through the reverse compounding of climate damage, because unfortunately the emissions that we're producing are accumulating in the atmosphere, and the damage that they do is accumulating, and so the value and the cost of that damage is accumulating and compounding. And yeah, that was one of the scarier insights I had while we were researching and working on the session. So I hope that's of interest to you.
Thanks, David. I haven't seen any other questions pop up, so maybe what I'll just leave everyone with is, if you have any further questions, whether they be big or small, please feel free to email them to whoever sends out the post-session email, whether that's Sandrine or myself. Yeah, very, very happy to help and point you in the right direction. And please do share on the recording of the session and the prior ones. Yeah, our entire goal with this whole exercise is to just get more people feeling more comfortable about their personal finance. So hopefully it's useful. Great. Thanks everyone again for your time, and have a fantastic rest of your Tuesday evening.
Thanks, everyone.
Thanks very much.
you.
Have a good